I'd like to share with you a little bit about how we construct these portfolios. So I think this is somewhat differentiated versus many of our global growth peers. We call this investing across the growth spectrum. In the aggregate, we're trying to construct a portfolio to drive that mid-teens earnings per share growth profile with the expectation that that drives the return profile over time. Every company plays a slightly different role. We're very happy to invest in high growth enterprises and even happy to pay higher multiples if the underlying earnings really supports that. So you can see companies on the far right like Amazon or Line or Autodesk. On the other end of the spectrum, though, we complement that with companies like Abbott Labs or Accenture, which we were looking at as an example, or Siemens Healthineers. These are businesses that may not grow earnings at 15% or higher rate over the long term, but they have sustainably been able to deliver, low double-digit to low teens earnings per share growth in good times, in bad times, really through environments because they're not quite as dynamic a growth company or quite as sexy in some sense, they're often quite reasonably valued. And so we're really putting this range of different types of growth companies together to achieve that earnings growth target, but to be able to do it at a valuation that's quite reasonable. And importantly, there's quality, sustainable advantages underneath each one of these companies. And I'll give you a couple of examples. So Adobe is owned for its strong growth. Adobe is nearly a monopoly, honestly, in the digital media creation field. And it is also a leader in digital marketing. And so this business started to transition to SaaS back in the 2011 timeframe. Today, the vast majority of their revenues are recurring. So 90% plus recurring revenue rate, selling digital media solutions, again, which they're nearly a monopoly in, and also offering digital marketing solutions where they have the largest, and I'd say most integrated and advanced suite of digital marketing capabilities. You can see the guardrails here just as an example of what the economics of this business are. Very high returns on equity and invested capital in a cash position, so strong balance sheet. And you can see the very strong earnings and free cash flow growth. I'd also highlight the margins. 45% operating margins is about as good as it gets, not just in software or SaaS, but in any business for that matter. Adobe is growing at a rate of roughly 20% on the top and bottom line, slightly below that recently, but right around that range with outstanding profitability and economics. So we've owned this for about 6 years. It's actually compounded at about a 30% rate, slightly higher than that over that 6-year period, playing its role in the portfolio perfectly. The chart at the bottom here shows just in the past, 14 months. So during 2021 and into the first couple of months of 2022, which have been an interesting time period. And you can see that over the short horizon, Adobe has actually underperformed or trailed a little bit. And I highlight this just to say that market volatility really gives us opportunities. We've compounded at an incredible rate since the inception of our position in Adobe. And that's inclusive of the recent pressure seen in the share price. And the recent share price pressure really gave us an opportunity to add to that position. So after a 20% pullback recently, we've added to that position. It's now more than a 6% weighting within the portfolio. I'll share one more example with you that's really at the other end of the spectrum. And this is Siemens Healthineers, which I highlighted in earlier comments. So not quite as sexy as a high growth digital marketing SaaS business, but it is the leader in imaging on a global basis. And it has been for quite a while. And this is a business that scale and reinvestment and innovation really drives more scale. It supports the largest service network to keep machines up and running. If a hospital spends millions of dollars on imaging equipment and there's any kind of glitch or downtime, they have to correct that quite quickly. So having a scaled enterprise being the leader in this space with the largest service force, they're able to do that. And again, importantly, that sales and earnings growth advantage enables them to reinvest, and they really lead across all different modalities, whether that be CT, MRI, and all the imaging fields. It's also really tied for second in diagnostics. It's a leader in this space. Roche is the largest diagnostics company in the world, and Siemens Healthineers and Abbott are tied for second place, very closely behind. It's really a global oligopoly, if you will. Another very attractive business, highly recurring in nature, and they've really been advancing their position through a new platform called the Telica, which is really winning way more than its fair share in the largest labs. And they've now come out with an Telica Lite that's going to, serve some of those smaller kind of spokes, if you would think of that as a hub and spoke approach in the lab marketplace. They also acquired Varian Medical very recently, and that's why if you look down at the guardrails, you'll see return on equity below 20%. Why is that? That's because they have goodwill on their balance sheet. And we're looking through that to the underlying economics of this business. Varian is an excellent business, one that they've actually had a partnership with for a decade, because Varian is the leader in radiotherapy. And as you can imagine, imaging is a very important component of delivering radiotherapy to the right place in the body. And so they've had this partnership for a long, long time. Now they've acquired Varian. And as we look forward in the coming years, I think they're going to be in an even more advantaged position to integrate their technologies and to bring best-in-class products. They're already both leaders in their field. I think this is only going to further their advantages over time. So Siemens has also played its role perfectly. We've owned it for about 3.5 years, and it's compounded right at the mid-teens. So for a highly durable safety business that tends to grow consistently through good times and through bad times, delivering that type of return, doing exactly what we'd aim to do. So every company on that spectrum has a story, and they're all advantaged, and I'd love to talk to you about more of them.